Managing finances between Canada and the U.S. isn't always straightforward, but that's where we come in. Welcome to our 5-episode video series on cross-border wealth management. I'm Joanne Kaban, financial planner and co-founder of Isle Wealth at Raymond James. Throughout this series, we're going to cover everything you need to know about managing wealth across borders, from the basics to taxes, retirement planning, real estate, and estate planning. There's a ton to navigate, but don't worry. That's exactly why we're all here. We're going to break it all down so you can avoid costly mistakes, make informed decisions, and most importantly, keep more of your hard-earned money where it belongs, in your pocket. So let's get started. First up, banking. If you banked in both countries, you probably noticed some huge differences. In Canada, banking is pretty simple. We have a handful of big banks, often called the Big Six, which dominate our market, offering mostly the same services no matter where you go. It's centralized, highly regulated, and relatively predictable. Now in the U.S., it's a whole different story. The banking system is like a buffet. There's thousands of options, from massive national banks to tiny regional credit unions. Each come with its own set of rules, fees, and quirks. This gives you more choice, but also more complexity, especially when you're managing money across borders. And let's not forget about regulations. In Canada, banking rules are set at the federal level, so things are pretty consistent. In the U.S., you've got federal and state regulations, which can make things, well, pretty interesting. So while Canada offers stability, the U.S. offers variety and sometimes a bit of financial whiplash. Taxes. Yeah, we're going to talk a lot about taxes today. And let's be honest, no matter what financial topic we cover in this series, taxes are always going to find a way to sneak into our conversation. It's just the nature of cross-border finance and finances in general. So let's tackle the big one first. Canada and the U.S. tax their residents very differently. In Canada, taxes are based on residency. So if you live in Canada, you owe Canadian taxes on your worldwide income. In the U.S., on the other hand, taxes are based on citizenship. So if you're a U.S. citizen living in Canada or anywhere else in the world for that matter, you still have to file U.S. taxes every single year. Yep, you heard that right. You can move from the United States to a remote cabin in our Canadian Rockies, cut all ties with the U.S. government, and they're still going to want to know what's going on with your bank account. The good news about this is Canada and the U.S. have a tax treaty that helps prevent double taxation. The bad news, it can be super hard to navigate. There's different types of income, like pensions, investments, or rental properties. They all have their own set of special rules when it comes to reporting them. So this is why working with a cross-border tax professional is so important. The goal isn't just to stay compliant, it's to make sure you're not paying $1 more than you have to. Next up, investing. Canadians and Americans have different types of accounts designed to help them save for retirement and other financial goals. In Canada, our go-to accounts are the RRSP, which is the Registered Retirement Savings Plan, and the TFSA, which is the Tax-Free Savings Account. In the U.S., their counterparts are the IRA, Individual Retirement Account, and the 401k. Now, these accounts all come with tax advantages, but here's where things get a little tricky. If you're a Canadian with U.S. investments or a U.S. citizen with Canadian investments, you could face unexpected tax bills or reporting requirements. Some accounts that are tax-free in Canada, like the TFSA, aren't given the same treatment under U.S. tax law. Translation: what seems like a great saving strategy in one country can turn into a tax headache in another. Again, a cross-border tax expert will be your best friend here. If you have assets or income in both Canada and the U.S., exchange rates can have a huge impact on your finances. A weak Canadian dollar can make your U.S. investments worth less. Well, a strong Canadian dollar may seem great until you actually need to exchange U.S. funds back into Canadian at a less favorable rate. This can be like a roller coaster you never signed up for, but by keeping an eye on exchange rates and using strategies like cross-border accounts or currency hedging, you can reduce the impact of fluctuations on your overall wealth. So how do we make all of this a little less complicated? Here are a few quick strategies to keep in mind. 1. Keep a cross-border bank account. This can help you manage money in both currencies without getting hit with unnecessary conversion fees. 2. Work with a tax expert who knows both systems. The tax treaty is great, but only if you know how to use it. And a good accountant can help you stay compliant and save money. 3. Keep an eye on exchange rates. Small fluctuations add up over time, so understanding when and how to convert your money can make a huge difference. Managing money across Canada and the U.S. isn't always easy, but with the right strategies, it's absolutely doable. The key is to stay informed, plan ahead, and get the right advice when you need it. And yes, I'm going to be talking a lot more about taxes in the future episodes because let's face it, they're everywhere in cross-border finance, but don't worry, we're going to make it as painless as possible. In our next episode, we're diving deeper into the tax considerations for dual citizens, snowbirds, and cross-border workers. If you fall into any of these categories or think you might, you're not going to want to miss it. Thanks for watching, and we'll see you in the next episode.